All right, let's kick off this explainer with a question that's literally going to change how you look at the stock market forever. Ask yourself right now, when you buy a stock, do you see yourself as a trader just flipping pieces of paper, or as a true owner of a real business? The answer to that question completely dictates whether you're going to spend your life stressing over daily market fluctuations or slowly, methodically building massive long-term wealth.
Welcome to The Explainer. Today, we're diving deep into the core contents of Jiva Ramaswamy's incredibly authoritative book, Creating a Portfolio Like Warren Buffett. We're going to extract the exact high-yield investment strategies used by the greatest investor in history and turn them into a systematic, actionable masterclass that you can literally start applying today.
We're going to break this whole thing down into 4 really logical pillars. First up, the owner mindset. Then, the rigorous research checklist. Third, valuation and margin of safety. And finally, portfolio management.
Okay, starting with Pillar 1, the mindset of a business owner. Before you even think about looking at a spreadsheet, you have to completely wire your brain for success. This is the absolute foundation. You've probably heard Warren Buffett's 2 cardinal rules before. Rule 1, never lose money. Rule 2, never forget rule number 1. It sounds almost too simple, right? But it's actually incredibly profound. The main goal here is the absolute avoidance of permanent capital loss. Think about the math. If you lose 50% of your capital, you have to make a 100% return just to get back to where you started. Avoiding that kind of permanent loss requires a total, fundamental shift in how you think about buying stocks.
Think about the stark contrast between a panicked trader and a calm, rational business owner. A trader buys a stock, sees a red line the next day, and completely freaks out. But an owner honestly wouldn't care if the stock market literally closed its doors for 5 years right after they buy. An owner looks at the underlying business, its revenue, its competitive advantage, the people running it, over a 10-year horizon. If the business itself is healthy, short-term price drops are entirely irrelevant.
So the crucial point is really about how you interact with the stock market. Benjamin Graham, who is Buffett's mentor, came up with this brilliant concept called Mr. Market. Imagine Mr. Market is your, kind of manic-depressive business partner. Every single day, he knocks on your door offering to buy your share or sell you his. Some days he's wildly optimistic and quotes a sky-high price. Other days, he's utterly depressed and offers a price that's ridiculously low. Your job as a business owner is to completely ignore his mood swings. You only do business with him when he's being irrationally pessimistic. Moving right along to Pillar 2, the stock research checklist. Once you've got that calm, rational mindset locked in, it's time to do the actual heavy lifting. So how do we actually find a truly outstanding business to own? To filter out all the noise, the source material gives us an exhaustive, highly structured checklist. We aren't relying on gut feelings here. It's a rigorous audit of 18 major questions and 61 minor ones. And they really all revolve around these core themes. Is the business simple enough for you to actually understand? Does it have a 10-year track record of solid profitability? Is its debt manageable? And honestly, is the management team trustworthy? Let's look at one absolutely critical question on that checklist regarding debt. Can the company pay off all its total debt using 5 years or less of its net income? If the answer is no, or if they're relying heavily on just rolling over long-term debt to survive a recession, you gotta just walk away immediately. Great companies with sustainable competitive advantages, they rarely need to rely on heavy borrowing to thrive. Another absolute deal breaker on the checklist is management integrity. Since you're acting as a true owner of the business, you need managers who aren't going to hide the truth from you. When you're reading those annual reports, does management report the bad news as frankly as the good news? Because if they're only boasting about their wins and burying all their mistakes in obscure financial footnotes that nobody can understand, run away. You do not want to partner with a dishonest management team.
All right, Pillar 3, valuation and margin of safety. We found an excellent company using our checklist. But here's the catch. An excellent company is only an excellent investment if you buy it at the right price.
So let's dive into the math of valuation for a second. You have to calculate a company's intrinsic value. Intrinsic value is the true calculated worth of a company. You figure this out by projecting the cash the business is going to generate into the future and discounting it back to today's dollars using a specific discount rate. Basically, you're calculating exactly what all their future profits are worth to you right now. This calculated number is your actual target. It is completely separate from whatever daily ticker price is flashing on your screen. And that brings us to the magic number 25%. This represents the absolute minimum discount below intrinsic value that you must demand before buying any stock. If a stock's market price isn't at least 25% lower than your calculated intrinsic value, you simply don't buy it. You sit on your hands and you wait.
That 25% discount, that acts as your margin of safety. Let's say you do the math and calculate a company's true intrinsic value at $30 a share. If Mr. Market panics and offers it to you for $20 a share, you're buying in at a 33% discount. That discount is quite literally a physical safety net. If your calculations were a bit off, or if the whole economy hits a recession, that margin of safety is what protects you from suffering a permanent loss of your capital.
Because your purchase price mathematically dictates your wealth, the compound annual returns based on the discount you secure are honestly mind-blowing. If the intrinsic value is $25 and you buy it at a 25% discount, your annualized return over 2 years is about 15%. But if you're patient, wait for a severe market crash, and secure a massive 75% discount, buying it for just $6.25, your compound annual return skyrockets to 100%. The deeper the discount you can wring out of a panicking market, the more astronomical your returns are going to become.
Which leads us nicely into Pillar 4, portfolio management and selling. Now that you know how to identify these great companies and buy them at a deep discount, let's talk about how you actually structure your portfolio and manage your investments over the long haul.
A massive mistake so many investors make is way over-diversifying. I'm talking owning 50 or 100 different stocks. According to the source material, to perfectly balance concentration and diversification, you really only need 10 to 20 carefully selected stocks spread across 7 to 10 unrelated industries. And honestly, you should weight your portfolio heavily toward your absolute highest conviction picks. You should be concentrating about 35 to 55% of your funds heavily in just your top 1 to 5 best ideas.
Now, a crucial point here on risk management. You have to avoid leverage. Never, ever use a margin account to borrow money to buy stocks. Why? Because the market can remain irrational way longer than you can remain solvent. If you borrow money and the stock price takes a temporary dip, your broker is going to force a margin call. You'll be forced to liquidate and sell your shares at the absolute bottom, locking in massive losses. And the worst part, that happens even if your underlying research about the company's long-term value was 100% correct. Now, eventually, you are going to need to know when to sell. But you never sell just because the stock's price went up quickly or dropped suddenly. Instead, you follow a really strict algorithmic process. You only sell when 1. The market price finally reaches or exceeds your calculated intrinsic value. 2. The company's fundamentals have permanently deteriorated and management simply can't fix it. Or 3. A significantly better, deeply discounted stock opportunity pops up, and you need to free up some capital to buy it.
And when it is finally time to sell because your intrinsic value target got hit, don't just dump everything at once. Execute your sale in deliberate tranches or staggered portions. Sell 5% to 10% of your holdings and then just pause. If the market's momentum keeps pushing the price even higher, sell another 5% to 10%. This staggered approach is what allows you to capture the highest possible average exit price. On the flip side, what do you do when bad news strikes and the market plummets? You completely ignore the short-term negative headlines. Seriously, don't panic. Sit down, recalculate the intrinsic value based on the actual new fundamental data. If you find that the intrinsic value dropped a little, but the panicked market price has plummeted way below that new value, say it's now at a 50% discount, you don't sell. You let logic and math dictate your actions, and you buy more.
All of these incredible systematic strategies we've been talking about are pulled directly from the core contents of Jiva Ramaswamy's definitive guide, Creating a Portfolio Like Warren Buffett, really diving deep into the exact methodologies of the world's most successful investor.
But remember, as the author explicitly points out, there are absolutely no shortcuts to successful investing. There's no magic trick, no hot stock tip that's going to make you wealthy overnight. You have to put in the rigorous reading, the checklist research, and the valuation math that most other people simply refuse to do. You have to have the patience to wait for Mr. Market to offer you that 25% discount and the logic to hold on for the long haul.
The blueprint is literally in your hands right now. You've got the mindset, the checklist, the valuation math, and the portfolio strategy. So the only question left for you is, are you going to keep letting Mr. Market control your emotions, or are you going to start building your wealth like a true business owner today? Thanks for joining me for this explainer, and I really look forward to seeing you apply these powerful principles.